All right, Dustin Tibbetts here, financial advisor with Jazz Wealth. How you guys doing today? It is a half day in the stock market. Actually, the stock market just closed. So if you're following along today and tomorrow, of course, the stock market closes today at 1 p.m. New York time. That is right now. So that's it. That's the end of the day. The market's closed a little bit lower. We're not going to do our market update today because that would be later in the day. It doesn't make sense. And we also have a class coming up for our clients later today. Now, tomorrow the stock market is closed, therefore Jazz Wealth will be closed as well. So if you have any questions or anything, well, you should probably be enjoying the 4th of July holiday. I hope you guys have a great, happy, and safe holiday. But we'll be back on Thursday, normal schedule as normal. So, all right, so today what I wanted to talk about was a question that I got from a customer. And very, very detailed question, by the way. So I thought we'd cover that. Before I get to that, actually, tonight, 8 o'clock Eastern Time, we're doing our class on candlesticks. So if you're one of our customers and you've been asking the questions, Dustin, I see the market update. I see what you have on your chart there for the price movements. What does all that mean? Explain it to me. And so tonight we're going to go over that. You should have that in your email, the link to join us for that class. We're going to start at 8 o'clock tonight to go over candlesticks. And I've had the privilege of teaching literally thousands of people all over the globe about investing this way, using charts and things. So we might have a few old friends stop by as well. But we'll start at 8 o'clock. So grab a glass of wine with me, come hang out. All right, let's get started. So a customer of ours sent some questions in. They were doing some online research about their investments and retirement and just trying to get knowledgeable. This is a very, very engaged customer. They're interested in learning more, as I hope all of you are. I always say I don't need a million customers. I need a small group of really engaged customers that want everything that I have to offer, and I'll just take you with me along for the ride. So this would be one of those customers for sure. And so basically they're looking around the internet, came across some articles and some videos, and it sparked some questions, as normally happens. Now, we've done videos in the past to sort of highlight the answers to these questions, but it's been a while, and YouTube's not very good at sorting the videos by content. I mean, we have playlists and stuff, but you know, it's what it is. So we are, I'm reading through this email basically, and I thought, you know, I'll just make a video out of it because there's a lot of great questions in here. And so what happened was the customer watched a video about rebalancing portfolios, volatility in the stock market, and sort of what to do and how to adjust about that. Now, this was a longer term portfolio manager that was giving the advice, and so the advice was really, really technical, let's say, and it wasn't very easy to understand. So basically the customer says, first of all, I know the markets are currently in a volatile state, and I've seen some declines with their Roth savings, right? So the first thing is, this customer, here's the market. You know, the stock market's done this for years and years, going on 9 years now, right? This customer has joined us right about here, okay? So the stock market hasn't made new highs. In fact, if you've joined us recently, yeah, the markets have days here and there where they're higher, but we're coming off of the high. We're in one of these sort of pullback moments right now. So if you've joined anywhere or bought any investments anytime in the last couple weeks to a couple months, you haven't seen any significant growth because it takes time, right? It just takes a long time. So the customer's saying, look, I see the volatility there, and I'm just curious. I want to learn more. First thing I'll point out is this, what the stock market's doing right now, is not volatile, okay? This is just normal market movements. Volatility is like what you saw in February. That is volatility. What you saw back in, there's a couple places along the way over the years, but back in 08, 09, that is volatility. So when people, you know, email me and they say, I see the markets, they're awfully volatile, I get a little chuckle out of that because, yeah, a little bit, right? But this is nothing compared to what can happen, okay? So here's how we can measure this. We're going to use something called the VIX. And if you're not familiar with the VIX, I will say, stay tuned. About a week and a half from now, you will be seeing the VIX all day or every day with us here. So I don't want to give away too much, but don't worry, we got you covered. It's something called the VIX. And I would love to do a geeky, in-depth class on the VIX futures, and the VIX ETFs and how they all work. I am fascinated by these products and have studied them inside and out. But for the sake of this quick one here, because it's a half day, we know everybody wants to get off to work or get off to vacation. The VIX is simply fear. That's all I want you to think about it for now. Okay? Of course, we'll define the living daylights out of what this is in a future class, but for now, it's fear. So what you're saying is when the markets are volatile, people are fearful. They're making major decisions, and it could be that they're selling some of their portfolio. It could be that they're just moving it elsewhere into different parts of the market. It doesn't necessarily mean that people are selling all the time. And this is how it goes. So if you were to look at a chart, and tonight maybe we'll highlight that in our live class. If you were to look at a chart of the markets, right, over the lifetime here, that's what you would see, right? You'd see a really, really nice uptrend. If you were to look at the volatility index, right, let's say this was the low of 2009, and of course, we know what this is. So what you would see is this, right, if you were to look at volatility, or the VIX, right? No matter how you want to look at it, you want to use futures or whatever you want to use. So it's an inverse relationship, and that's because as the markets do well, fear subsides, right? People aren't scared anymore. Well, what's happened here is now we've reached this point where the stock market, we could argue, is at a higher end of its peak, right? And all of a sudden, volatility, where it was sort of creeping down, is all of a sudden doing this. Right? There's lots of little movements like this if you were to look at the chart, and that's because the stock market all of a sudden is like bam, down, oh man, we're having these little trouble spots. And so the fear, of course, is a little greater than normal, but that's the measurement. That's what you use to detect that. Now we say that the volatility is very low right now because relative to history, the VIX is trading around like 1575 or something. The market closed lower today. Maybe it's closer to 16 price-wise. When the market spiked back in February to the downside, remember the markets were moving along and then bam, 10% in 12 days. When that happened, volatility shot up to over 35, right? So double, right? Basically everybody was just doing fine and then boom, double. Huge spike in volatility. That's volatility. Now there's an old saying, and then I'll move on from this. When the VIX, there's two old sayings. First of all, if you hear one of these sayings, one of them is very, very accurate. The other one is unbelievably ridiculous, and you should forget it right away. The first is, when the VIX is high, you fly. When the VIX is low, you go slow. And what that's trying to tell you is when the VIX is high, meaning there's a ton of fear in the market, you fly out of the market. When the VIX is low, there's no fear in the market. What the saying is trying to tell you is you go slow, you don't make any adjustments. And that's ridiculous. I want you to forget that forever. Because what does that mean? If this is the stock market, right? The stock market's going up and volatility is down. When the VIX is high, wasn't that a discount? Wasn't this some of the best prices that you've seen, 2009 and so on? Here's 2018. And so now if the VIX is low, you go slow, right? At these higher prices, why would you do that? So my saying is when the VIX is high, you buy. When the VIX is low, you go, right? Go ahead, take some of your profits, start reducing your portfolio a little bit or start protecting it, right? Put levels in there where you can say, look, if it goes under this, I want out. You can do that if you're doing the investments yourself. So that's the measure of it. When the VIX is high, you want to buy. That's when Warren Buffett's laughing at you because you're scared, everybody's scared, and he's buying. VIX is high, you buy. VIX is low, you go. Or you just hang out, do whatever you want. Not a big deal. So that was the first part of her question. Volatility in the markets right now is very low, relatively speaking, to the history. Now, if you were to crunch that window down to January through now, you could say volatility is much higher than average. That would be a valid argument. But we're talking about 25 years, and the customer even references later that they still have 25 years or so left until they call it quits on their career. So we wouldn't want to take a 6-month window and say, oh my God, volatility is really high, I want to panic. No need to do that, okay? So that's the first thing. Hopefully you learned something about volatility. VIX is the way you look at that. You'll see it everywhere. It's always on the TV and everything. In about a week and a half, you're going to see it on Jazz as well. So that was the first part. The second part was rebalancing. So there was a video this customer watched where they said, you need to rebalance your portfolio. If you haven't rebalanced, you need to rebalance. And she was saying, the customer was saying, well, how often do I do that, and what exactly does that mean? I'm going to make this really simple. Let's say, well, let's not say, we know that in 2017, you got a 20% return stock market, okay? 2018, baby, just a little baby here. What was it, 1.8? So far, but we're still going, right? So we don't know what the market's going to hold. It probably not 20%. So record year for the markets. Now, if you had a portfolio, let's say you had $10,000, and we did a video on this last week, really in-depth one here, and let's say somebody told you that I want you to go 50% stocks for some reason, and 50% bonds. All right, and that was your allocation. So what happens is you go, all right, great, 50-50. I got 5,000 in each, no problem. What happened last year in the stock market? If you were holding this portfolio, you had a 20% rally in stocks. Huge rally, record setting. So if you have 5,000 here, and this guy has a 20% gain, how much do you now have here? You're looking at $6,000, right? Now, bonds did lose value, but I don't have a way to quantify that right now. I can't say what this is, so I don't know for sure. For easy math, I'm gonna say this lost value. Interest rates went up, the prices of your bonds went down, and so what happened? All of a sudden, without doing anything in 2017, you had 50-50, but now what? You've got 60-40. You've all of a sudden taken on more risk in stocks. And you go, well, that's cool because I got a profit. So I made 20% on my stocks, bonds fell a little, I'm cool with that. Are you cool with that? Because what happens if this year, it's 2018, and all of a sudden the markets lose 8%? What happens if that is what happens? Now all of a sudden your risk is 60% in stocks, and if they fall 8%, you are now losing on 60% of your portfolio versus 50%. Maybe just, that's not like a lot. Maybe you're not panicking about that. But if you were already at 60%, now where are you? 72, 73, 74, 75% in stocks. And so that's what they mean by rebalancing. Typically, we don't need to put such an emphasis on the timing of it. We don't actually say, look at it every quarter or every, twice a year or something. But because the markets did so well last year, that's why you have videos like what she watched and articles that you read where people say you need to rebalance, especially if you're closer to retirement. If you have 20 years to go or 10 years left till retirement, then that excess risk is pretty cool, right? Who knows? This month or this year, next year, and the year after may only return 2, 3, 4, 5%, nothing exciting, but now you're making more and you've got some wiggle room, so fine. But if you're close to retirement, if this were even 30% stocks to bonds, you now are taking excess risk. And that's what that means. So hopefully that clears that one up. So one of the questions was, I noticed she posted that we rebalance on a daily basis. We don't actually rebalance on a daily basis. So it's just a matter of terms here. We don't rebalance, we tweak speed. So we look at our portfolios and say, if the markets are going to move at 100 miles an hour, this portfolio we want to move at 100, this one we want to move at 80, this one at 60, and so on and so on. And so what we're doing is we see that this one's moving in line perfectly, this one and this one, let's say they're doing just fine. Something happens in here which causes our portfolio to all of a sudden move at 98. And so let's say one of the positions slows down or somebody gets bought out or whatever. So our tweak is to go into this portfolio. Let's say we've got all these different positions. Our tweak is to say, nope, we need it to go 100. And so we'll go in there, not on a daily basis, but we'll go in and say, okay, if we take this one out, add these two, and make this position a little bit bigger, we're back to 100 again. And so I want to just clear that up in her question there because we definitely do not rebalance every single day. All right. And then the fourth question they had, and this will wrap it up, was how often do you think you should meet with us? How often should we meet together to discuss setting up a portion for growth and setting up another portion to prevent loss? I think we should meet as much as you're engaged in this. If you want to talk about it a lot, that's fine with me. Once a month, we'll do an update on all of this to let you know how things go. But of course, if any of our customers that have any questions at any time, I'm more than happy to talk about it. There are some days where I don't stop. I mean, I wake up and just get going. Once I'm, all set up and get to work and everything, it's like nuts, and nothing happens at 10 o'clock at night. All of a sudden, I'm like, wow, that was a quick day. And then there's other days where nobody wants to talk, and it's just me, and I'm like creating ideas and stuff. So I'm happy to talk about it whenever you like. But I want to highlight one part here. The client says, setting up a portion for growth and setting up another portion to prevent loss. We did a video the other day. We talked about how you don't actually lose or gain anything until you sell, but you actually only have one choice here. So you can either have growth or you can prevent loss, right? So you kind of have to make that decision. It is impossible to get good performance while preventing loss. So loss needs to be defined. If you're looking at us for the first time and you're like, I'm not sure what the hell he's saying here, but if you're looking at this, there's a lot of companies that say, we will invest this way and we will hedge against the downside, or we will hedge against risk or protect against downside. You hear these things, and anytime somebody says that, that comes at a sacrifice of growth. So you can have all the growth in the world. You can have a portfolio that beats the stock market by 1.5 times very easily, but you are not going to be preventing any kind of loss. You're going to be exposed to a lot of loss if if the markets end up falling. When someone says, we can prevent loss by X amount, let's say it's just this shaded area here, you are now giving up some of the growth. So it's a balance, right? And so that's why we have the different portfolios on our website to say, look, if you want all the growth in the world, we're going to give it to you, but don't come crying when the markets fall, because it's going to happen, and you're going to need that sort of tough mindset to get through it. If you don't want that much and you only want a little bit here, well, we can help you suffer a little less on the downside, right? And actually, next week we're going to be announcing our newest portfolio. So we have tons of portfolios on our, we have 6 portfolios on our website. We have tons of them privately that we haven't launched yet, because everything has to be approved. It's got to be looked over top to bottom, and compliance this and that. Lots of money to get them to do this right. But we have a portfolio that we're going to launch just for really a few customers that wanted this. We've had it for a long time, but what it does is it says if the S&P 500 goes up, 5%, right? If this is the S&P 500, let's say it gains 5%, we're going to have a portfolio for you that will lose exactly 5%, right? This would be you. So why would anybody do that? What would be the purpose of that portfolio? When we talk about speed in our portfolio, where we're going to move with the market or move some percentage or move some percentage or some percentage, there are actually customers that say, Dustin, Trump scares the daylight out of me. I'm scared of the tariffs. They fall for the news, really, and they want to do something about it. And I might disagree, but it's my job to provide you what you think is best for your goals and give you advice along the way. So what we want to make public, and I've thought about this for months now, is a portfolio that will move in the same speed as the market, but exactly the other direction. And so I've got to do a whole video on this because I want to make sure you guys understand what you're getting into. But basically, if you think the markets are going to fall in the short term, then you could actually position your portfolio to participate on the downside. If the markets do fall, right, let's say the stock market ends up falling 5%, rather than sit through it, if you were correct, you would actually gain 5%. So hopefully those of you that kind of see our speed portfolio or speed when we talk about that in portfolios. Hopefully you get it. But we'll go over that. We're going to definitely cover that top to bottom. Anyways, just wanted to cover a simple email from a customer that answered really a lot of different questions. I hope it didn't create a lot more questions, but you know, we'll see. So if you have any questions, I'll be happy to answer them. Remember, we are not doing our stock market update today. The stock market's closed. We are going to do our class for customers tonight. I'll answer some of your questions here if you have them. Chat with Jazz. Oh, thanks, Chris. Yeah, no problem. I'll be hanging out if anybody does have any questions, actually. I don't have any big plans. Warren Buffett says investing in bonds is a terrible idea, and if you're going to do so, only invest in short-term government bonds. Thoughts? I know why he's saying that, right? Because if you are buying bonds at the lowest that they've ever paid in history, you know, what's the upside? What are you looking for? As interest rates go up, the value of those bonds are going to go down, and you're already seeing that. So many portfolios are seeing that. And Thomas, we did a lot of videos over the last couple months where we would talk about the mutual funds that people invest in have bonds built into them. They have to. So what's happening is mutual funds were not outperforming because those bonds were holding them back. So they were shifting money more and more into equities, taking on excess risk with your pension funds, with your retirement, your target date funds in particular. That was a big one. They were taking excess risk with the equity side to try to make up some of the losses on the bond side. So that's basically what Warren Buffett is saying. They are an underperformer and will continue to be an underperformer. So that's that. Why do most retirement specialists don't account for wage increase with the average U.S. wage going up to 6.21? Well, here's the way I look at it. I have no idea what other advisors or retirement specialists do. Retirement planners, we're not financial planners, we don't know. We specialize in the investing side of it. We're going to make sure that if you want a certain growth, we're the ones that kind of manage that. I'll help you with the planning and everything, but what I found is that every single person wants a different metric used for inflation, Social Security, wage increases is also one, and so an average return is another one. So rather than generally say, I've done some videos where I just put stuff out and I'm like, generally, let's talk about inflation at this amount, let's talk about returns at this amount, and some people bash me because it's not the number they would use, and I find that with our customers, they want to use their numbers. They say, don't, put me down for half Social Security, inflation at 3.4% or whatever. And so I'll leave it up to them. We'll talk about it, I'll give you my opinion, but if you want to use a more aggressive or more conservative number, I think that's probably why people do that. We're not really sure what number to use, and so ultimately we want the customer to know if we use this number, you're going to end up with X number of dollars. So let's use this number that's higher so you end up with less money. Worst case, you're happy when you get there. So that's probably why. All right, well, we're going to wrap it up there. Stock market is crash. Okay. Well, let's hope not. Is cashing out a good idea? I have done so many videos to prove to you why cashing out is a horrible idea. And in fact, we're actually going to do that video again next week, maybe later this week. What if you bought at the absolute high every peak in the market? What happens if you saved your money and then you bought at the high and the market crashed? And then you just saved your money, then you bought all in at the market high and it crashed. What would happen? Meaning you bought at the worst possible time since 1960 or 70, saving for retirement, and now that you are of retirement age, what would have happened? So it's one of those classes we're going to do, Jamie. I would stay tuned because it has a really, really interesting outcome, which I don't know why anybody would do anything different once I share this with you. So hope you enjoy. Have a great, safe 4th of July holiday, guys. Remember, fireworks, you put them down, you light them, you run away and enjoy the view. You do not hold them or put them on your head. So, hey, got 4 fingers on this hand. Did it come from fireworks and holding a firework in my hand? I wonder. Anyways, enjoy, be safe, have a great time. If you're available Thursday, we'll be back doing things the normal way, and thanks for watching.